Hello everybody. We are jumping after Stordalen, as we say in Norwegian, and trying to get some content into this. We all know the context. Share prices in the stock market for TechSaaS companies have fallen and fallen. At the same time, we see private equity buying companies with 40, 50, 100% premium. So we here have a panel to discuss and give us some insight into that. Unfortunately, Jens Rugseth had to cancel. But we have Erik Hagen of Viking Venture, who have put 4 companies on the stock exchange. And they're all now sold, so congratulations on that. We have Ola Nordquist from Permira, a global PE firm with lots of private and public investments, including Adevinta here in Norway. And we have Ole Petter Kjerkreit, who used to be the best ranked tech analyst in Norway. He used that now to become a very successful investor and quite a profile investor over the last few years. So Ole Petter, I thought we'd start with you. You once described the Euronext growth companies as selling a dream. Could you elaborate on that and say, is this uniform across the whole Euronext universe, or do you see some nuances?
Thanks for the invitation. When it comes to the backdrop here, we've been through a kind of a speculative bubble in the stock market, in my view, driven much by extraordinarily low interest rates. Also, central banks flooding the market with money. That created speculation in enormous scale, mainly much driven by the retail investor segment, but also followed by others. So this led to many new companies coming to the stock exchange. Some were good, some were not prepared. Very low requirements to be listed in the Euronext stock exchange in Norway. I think we got 130 companies within a 2-year time period. That's extraordinary in a historical context and also in a global comparison. So and in this period, we also fueled by this speculation in the market. Many come to the market quite immature with very high and lofty ambitions, which with all kind of objective research and analysis would be more or less impossible to be reached. All those targets, typically 5 years down the road or something. And this these companies, some of them were good, but they just came to the market with a too high valuation and with kind of ambitions pointing to a level that was impossible to reach. So that was the backdrop here, and I guess we will come more back to where we are now. For now we are at a different state, but that was what happened, and what I also meant by saying that they were selling a dream that in terms of targets and valuation couldn't be reached.
Yeah, Erik, you had 4 companies on Euronext growth, and they're all now taken public. So were they selling a dream, or were they 4 of the good ones? And all 4 now been sold to PE or PE-backed companies. So what are they seeing that the Norwegian public investors are not seeing?
Well, first of all, I think that on any stock exchange, the role of the investor is to pick the good companies and try to avoid the bad companies, and that goes where Euronext growth as well. So looking at the 4 companies we have now delisted, I mean, they're bought by companies like Thoma Bravo with Mercell, is regarded as the best software investor in the world. So I think it shows us that we can really also, through the use of capital from the stock exchange, to kind of drive and build really, really good companies also from an international point of view. But I think what's happening now is that I totally agree with the Fridtjof earlier today, and we've gone from extreme low interest rates to higher interest rates and inflation, and of course that takes down the value of future cash flows. So that's of course. But what we see is that at least for our portfolio, our companies, it's a financial situation that has changed. So it's if you put it into Excel, you see that the value will go down. What is very interesting is that if you look at our portfolio, we're the leading Nordic business-to-business software investor. We now have some 3 billion Norwegian kroner of ARR, of recurring revenues. And we see that the companies are growing as fast as they ever did. They grow on average 44% per year. If you look at what's happening now with the increasing inflation, and increasing labor costs. Everyone wants to take the labor costs down. In order to do that, you need digitization, and then you need software. So it's a financial correction, but if you look at the underlying product markets, they're growing as fast as ever. So there's nothing wrong with the market for business-to-business software. And I think that's the reason why, if you then are a big private equity player, what is the easy now? You can now buy companies that, if you look at the Viking Venture SaaS index, it's down 56% in a year. If you look at multiples, companies now on average trading at 3.2 times last 12 months sales. It used to be up to 8, meaning that these players can get really good companies at the discount and still pay the premiums that you talked about up to 100%. And for the, as Fridtjof also said, for these private equity players, they have plenty of cash. They have time. So what they're doing is that building great companies for them to be platforms in order to continue growing rapidly organically and to buy other companies and grow inorganically. And if you have the money and if you have the time spent, you can both increase the revenues and the profitability of companies, and hopefully also see that multiples will come back again, meaning that you will have a better company at high multiples, driving very strong returns. So at least I think that what we'll see that these companies now, or these private equity players and companies backed by private equity taking companies of the stock exchanges, that there will be great investments. There were great investments for us, and there will be great investments for the next investor as well.
Ola, that sounds like something you can build on, being a, what do you say, a big private equity player. So do you see the same across Europe, or is this a specific Norwegian phenomenon?
No, I actually think this is something that we see across the world. And as was mentioned before, you've seen an exceptional re-rating. And I think you almost have to start with saying that we've seen 12, 13 years of unprecedented growth, and valuation has only gone one way. I don't think we can look at any other period in time where that has been happening. I think one thing for sure is knowing that they will always come to an end, and we are dealing with a zero to negative interest rate environment. So all the money simply has to flow straight into the stock exchange. Now, this of course creates tremendous opportunity, and I think it's if you look around the world right now, valuations have come down. But quite frankly, I don't think we should always be thinking that this is just a short-term correction. We actually talk about before 2022 and after. We are actually of the view right now that we do not believe 2021 is going to come back. We think this has been an anomaly. We have to adjust and adopt to the new reality. And this means that over time, investors, companies, and ourselves have to adjust to this new reality. And this is also why you see also, whilst some public to privates happen, there's a lot of public to privates that do not happen because you have expectation differentiations between buyers and sellers who, quite frankly, have different views, excuse me, of the world. Now, if you look at this, you combine this with what I would call an unprecedented debt situation. This is the first time in my history, I've been doing private equity the last 20 years, with banks, all the big international investment banks, are basically shut. So at the time when you see valuation come down, you have a time where financing is actually not available anymore. And this is a unique phenomenon. Now, we're not talking about small pockets in small regions, we're talking sort of at large global scale. And this is really interesting because now that is, how is that solved? That's solved by the private credit market. But it's a finite resource. It's not a pool that is available everywhere to everyone. So financing is being quite tricky. So although we see that right now could be the perfect opportunity, and we ourselves have been able to succeed with 2 large buyouts this year, in the all the way up to $10 billion. But these are difficult to get around, very difficult to finance. I think in Norway, specifically, you have some different circumstances where there's been a super rotation into energy. So I think the Norwegian stock market, quite frankly, is more hit than many other markets. But I would say, Tarjei, to your question, we see opportunities all over the world. However, execution possibility on these ones are still a bit tricky, given the level of financing and also the buy spread differentiation you have.
Ole Petter, you had a...
Yeah. couple of comments. Agree much of your assessments there. But firstly, I'm not, have kind of the expectations been met, and this business is as fun as ever. I'm not obviously talking about the specific your portfolio. I'm talking in general. And for Euronext Stock Exchange, well, if you aggregate all the estimates over the past couple of years, you will see that the estimates are massively down. Yeah. Now, also been through looking at the targets of many of these companies, have them been met, and with very few exceptions, they have not been met, or they are, it's not priced in here. So there is a kind of a corrections both on valuations and compared to expectations there. But where we stand now, I think we are on our way to some kind of more normality. That's my hypothesis. The market has not been normal. But we are going to come to a more normalized market, more normalized interest rates, more normalized business. That will create some opportunities. But on the way there, there's a big shakeout in the financial markets. And in the big shakeouts, we haven't kind of necessarily found the normality yet. And one example of that is also the availability of credit. It has been very easy for many years, but now the global credit markets, they are basically shut down. Correct. So that's great, not kind of a sustainable situation either. So we are on our way. We'll come to a more normal situation with more normal ways of evaluating businesses, with more normal valuation, but will also more normal access to capital. That's my hypothesis, at least.
Erik?
Yeah, I agree, and I think that, of course, that's very challenging for companies being listed. So if you look at the 44% growth our portfolio has, half is organic and the other is inorganic. So what happens if you're a listed company and suddenly stock prices plummet? There's no debt to be taken anywhere. You basically take away 50% of your growth possibilities. That's acquiring other companies and integrated them onto your own platform. That means that these companies now have a significant disadvantage on the stock exchange. And I think that's also hurting there in terms of valuation, of course, because the growth prospects for these listed companies are much lower than they used to be. That's also the reason why we mean that for our companies, the right thing was to be listed, because that was the cheapest available capital. But it's also now the right way to be privately held, because they can now get the funding they need in order to both do organic and inorganic growth. So I think that's where we'll see that the privately held companies by private equity, they will be able to grow much faster going forward. I think that's also the reason why even if you had a 42, 60, 70 or 110% premium, that's what happened to our companies, these will still be good investments, because you can acquire other companies as a privately held company, and also in a situation where valuation is coming down, makes it even more attractive to kind of pick up companies at a completely different price. So that's why at this point in time it's very strange, because they have pricing publicly and pricing private almost the same. And we've been discussing with banks the last 2 weeks, and some of them have not the liquidity discount anymore, it's a negative liquidity discount. They feel that the companies are valued higher privately held than they are public. And I think one of the reasons is because as a private company, you can now grow much faster.
Do you agree with that, Ola, that it's easier to develop a company and fund a company in a private setting?
I mean, everything has its place, so I don't think it's an either or. But I must say the proposition of being private, I think, is always a very attractive one, specifically when you're in high growth phases, when you're in a situation of changing strategy, when you're going to take drastic moves. I mean, we shouldn't underestimate the amount of time. I don't know how many of you are public CEOs in this audience, but you know, the constant thing that you meet of public CEOs is the amount of time they spend with external markets. Analyst calls, worrying about market perception, and being in the freedom of locked doors of a private ownership, you know, gives you the opportunity to take drastic measures. You're not going to be measured on quarterly earnings. You're going to actually be measured about the long-term trajectory. And you know, today's a SaaS conference, for example. You can imagine the amount of companies that are going through a SaaS transition. You actually know you take a lot of short-term pain for long-term gain. And doing this in the public eye, was for the early adopters not an easy thing. So we believe the private alternative is really still very attractive, very appealing, and then also to have a partner with you who can actually support you and help you. Because one of the things I think in public ownership is you very rarely have super active owners. If you are in a private ownership in a private equity context, and Erik will know this as well as I do, you will actually roll up your sleeves, be available 24/7, and also open up your network, your capabilities. We have a portfolio of 75 companies, and we call it every company who comes in is part of the same Permira family, meaning you have 75 people to draw from, with the capability to support these companies. So the benefit of that I don't think should be underestimated. Now, there will of course come a point in time when that journey is over, and the public market it can be a very good alternative, but I still think the relevance is very much there.
Erik, I know that you set up as SPV to invest in minority positions on the stock exchange.
Yep.
So give us a bit of background on that, and what are you looking for specifically as a good investment?
Yeah, so we are an active minority investor in business-to-business growth stage software companies in the Nordics. And to us, whether you're listed or unlisted, that's how you trade shares. But the thing you have to do with the companies in order to make them grow at 44% is basically the same. You have to work on pricing, you have to work on scalable sales processes, you have to work on add-on acquisitions, and so on. And of course, what we see is that when you have market corrections like we have now, the public markets, they react immediately. And there's a 6 to 12 months lag on the private market. So the private markets, I think, is still going down. It's still hard for buyers and sellers to meet. Sellers remember the old pricing, and buyers, they are focused on new pricing. Well, that happens instantaneously in the public market. So that's why we've set up a vehicle to invest in, to be an active investor in public companies. And we've made the first investment. Can't tell you what it is because we're still picking shares. But our ambition is to be a 30-40% investor in also listed companies. And we look for the same as you always do. That's really good business-to-business software companies, growing, having international potential. And the most important thing for us, supporting really critical work processes. Like you heard today, when you run a hotel, there's lots of critical processes where you need software. And for that type of software, it's really sticky. You will stay with it for a long period of time. So that's what we're looking for.
Does that?
And we have looking at, and of course, trying to find undervalued companies. So we have our own valuation methodology built for many years. So when we see a company that's too low valued on the stock exchange compared to what we think the value is, that's a good investment opportunity for us.
Ole Petter, what needs to change for you to become positive to some tech stocks again?
Yeah, I can come back to that, but before a comment on what you've said, pretty much agree on your assessment there. There is kind of to some extent a discrepancy now between the willingness to pay up by PE fund and others and the public markets, but this will likely to some extent convert at some point, because what we're seeing now is that those investors in public equities in kind of high growth stocks, they have been punished hard. Typically, they may be down 60-70% or so their portfolio. So they have burnt their fingers. While the PE funds that have had a huge support also over time, given low interest rates and multiple expansion, and have got the gathered money into these good markets, we're sitting on a lot of cash. So to some extent, they have the flexibility, and they to some extent, so they think their valuation of the portfolio is there. But if you do kind of a peer group and assessments, it's probably is down quite significantly. They have not seen the reality in the same way as those in the public market yet. But there will be a kind of a convergence there. They're still, but they have still may have a good value proposition. There is probably opportunities to buy now. I agree on that. So being kind of optimistic and pick the best companies at a reasonable price, it's interesting, and that's also valid for myself. My plan during this period has been to kind of being on the short position during the period of madness. I have pretty much, in terms of kind of the non-profitable tech space, I'm pretty much neutralized this now. My plan is to, when we are at the right time, try to start picking kind of stocks that have fallen far below what I think is fair value, and pick a portfolio of those. I'm not able to pick maybe the winners, but if I pick 5 or 10 that I think have good prospects, I'll probably get hopefully some 10 baggers within that portfolio. That's my plan. But shortly, what should companies kind of do in this situation? It's a very demanding situation for companies, having been through this completely different environment. But now, well, simply focus on building a sound and profitable business, not maybe chasing that kind of growth, because you will maybe not get financing. There will be also tough macro limiting that. But if you kind of stone by stone build a credible business, create a credible path to good profitability, and then that's the way out of this. And soon I'm on the shareholder list, maybe.
Very good. Look forward to seeing you here again next year as a big shareholder. And Ola, to final question here is, what are you looking for in unique companies that you would consider buying? What is characterizing a very good tech company in your mind?
You want to have the secret sauce, basically.
Yes.
Exactly.
I'll turn off the microphone.
Great. No, I mean, it starts actually with the basics. We are investors, thematic investors. Tech is our largest sector, more than 50%. We have just raised more or less 20 billion euros. And if you look at this, we always start with the product. It starts with the product. Is it a great product? Number one. Number two, do we have enough of a market opportunity? And three, do we see very sound unit economics? Is it a profitable business model? And lastly, a great management team. And these are elements that, quite frankly, if you stick to these elements, you rarely go wrong. So really holding yourself up onto this. And also, as was said here before, in today's market, we also see that there's been an over-indexation on just going for growth without thinking about profitability. So we really want to make sure that with this good unit economics, there also is a good path to profitability. So it's more or less at your discretion if you're going to be profitable or not. Sometimes, particularly for fast-growing software companies, the right thing to do is to invest and go for growth. But you should also know that if you turn off that sales and marketing spend, you should be able to find real solid profitability under there. So these are some of the elements we're looking at. But I think, maybe finally today, I think it's also important to recognize, I don't think we just are dealing with a valuation environment that is challenging. I quite frankly don't think we've seen the worst yet. We sort of predict that 23 will be a much more challenging year than 22. Because as you say, as the economy slows down, as inflation increase, we would have to expect that the companies, their underlying performance is going to hit more challenging environments. So we should expect to see a slowdown here. Now, that's not all bad. That can be a healthy thing. And as an investor, there also comes opportunities.
Very good. Thank you to everybody. And thank you. Next is Melissa Mulholland of Crayon. So we look forward to that in a couple of minutes. Thank you.